Every measure of equity valuation suggests the stock market is overextended, yet traditional gauges of financial stress remain remarkably quiet. This gap between record stock prices and calm credit markets hides a massive structural shift occurring in the background. To find the actual pressure, we have to look at the 30-year U.S. Treasury bond. This single asset functions as the baseline for global finance, the absolute foundation against which the price of every other long-term investment is set. The stability of this foundation relies on a constant chain of purchase and custody. For 3 decades, that chain was anchored by foreign nations willing to supply the world's cheap capital by holding massive quantities of American debt. This chart shows that the world's biggest buyers are retreating. China has halved its holdings of U.S. Treasuries since 2013, reaching its lowest level since the 2008 crisis. Simultaneously, Japanese institutions have begun selling off billions in American debt to find better yields at home. When foreign central banks stop rolling over their debt, Washington is forced to clear its auctions with domestic buyers. To attract those buyers, the government must offer increasingly higher yields, placing direct stress on the country's interest bill. Washington responded to this lack of foreign buyers by shortening its own debt issuance. This strategy, nicknamed Bill and Chill, shifted the government's focus from long-term coupons to short-term bills that money funds could easily absorb. This pivot created a problem for pension funds and insurers, who require 30-year duration to match their future liabilities. By stopping the flow of long-term sovereign paper, the Treasury left these massive institutional investors starving for assets. American technology companies have moved to fill this specific void. Roughly 2/5 of all investment-grade debt issued at 15 years or longer this year has come from corporations building out artificial intelligence. You can see the scale of this in Broadcom's attempt to raise $100 billion for AI chips. The deal uses a special purpose vehicle to keep the debt off balance sheet, while using a hidden structural guarantee from the parent company to attract investors. These guarantees win the debt and investment-grade rating, allowing pension funds to treat it as a safe alternative to treasuries. This accounting treatment masks the fact that the risk hasn't disappeared, it has simply been moved. Because the U.S. government has retreated to short-term debt, these technology corporations are now the marginal suppliers of the 30-year paper anchoring global finance. The world's duration is now backed by corporate revenue rather than sovereign taxing power. This entire corporate debt structure is underwritten by a single assumption, that AI services will sell for a high price in the year 2030. If that revenue model fails, the ability to service these $100 billion leases vanishes. That revenue case is now being dismantled. In April, DeepSeek released a model with 1 trillion parameters, tuned specifically for Huawei's domestic chips, bypassing the need for expensive American silicon. The cost difference is drastic. Independent analysis suggests these Chinese models can operate at 1/6 to 1/4 of the cost of their American equivalents, putting immediate downward pressure on the global price of AI. Emerging markets are already integrating these cheaper stacks. From Malaysia's sovereign AI to Singapore's banking sector, countries are running Chinese models alongside American ones, choosing efficiency over brand loyalty. China is effectively executing a two-front assault, withdrawing the capital that funds U.S. sovereign debt while simultaneously destroying the revenue model needed to pay off the corporate AI debt that replaced it. The market looks calm because this massive debt load is engineered to stay out of the high-yield indices. As long as the ratings remain investment grade, the traditional warning lights stay dark. But the cost of insuring against a default tells a different story. Credit default swaps, the tech giants, the hyperscalers, are currently spiking toward record highs, revealing a deep institutional fear that the public indexes cannot see. Global central banks are already voting with their capital. In a single quarter, they purchased a record 288.9 tons of physical gold, the highest volume ever recorded by the World Gold Council. Central banks typically avoid buying assets during a price collapse. Doing so at record volumes reveals a fundamental reassessment of what a reserve asset should be in a world where sovereign debt is being questioned. The rising cost of American debt acts as a black hole for global capital. As U.S. yields climb, money is pulled away from emerging markets to chase the perceived safety of the dollar's front end. Countries like India rely on captive domestic savings to protect their markets, but these internal flows only act as a temporary speed bump. They cannot stop the momentum of a massive global reallocation of capital. If the AI bubble pops, capital spending freezes in the US will instantly hit the order books of Indian IT firms. The risk budget that funds foreign ownership of these emerging markets will contract, leading to a shock similar to the 2008 crisis. History shows that opaque credit markets always fracture months before the general public notices. In both 1999 and 2007, credit spreads widened and redemptions were suspended long before the stock market bottomed out. The stress is already breaking the surface. Over 3 weeks, the U.S. Treasury engaged in emergency joint yen buying operations and dollar borrowing facilities to prevent the long end of the market from spiraling out of control. A sovereign superpower that spends weeks proving it can still place 30-year paper has already signaled the loss of its underlying creditworthiness. For those riding the current wave, the warning lights are no longer a glitch.